Hey everybody, Dan here, and we've got about 15 minutes before the close. I'm doing an interview with Ali Coram. She's one of the folks at IBD for a Friday podcast. I guess it's something that she does. I'm not sure if it's live or not, but I will send you. I'll give you a link or send you information on it. Excuse me for stuttering. I'll give you information on it when I get it. But what I thought I'd do, and what I'm going to do, is go through some of the rules or some of the things that I plan on talking to her about. But first, we'll just go through the strategy session, not really covering any stocks differently than what I covered yesterday. A lot of those stocks are stocks that you really want to watch, really, because I think they really give us some strong possibilities. But when I explain to you some of the things that I'm going to be talking to Ali about, you'll kind of get why I'm saying not right here, not right now. So with the S&P, okay, we got a massive rally yesterday. Big gap down, big reversal. Oh my God, it's all in. FOMO, get in before you miss the train. And then today, a little gap up, which is where all the folks who were eager to get in got in. Meanwhile, technical traders and large money managers who are still in a bear market were saying like, crap, okay, we have time to distribute more stock. Also, they look at the 20-day moving average and say, this is for me, happens every time, so we'll go ahead and sell into it. And by the way, one thing to keep in mind, in an uptrending market, the S&P will stay, and this is true for stocks too, it'll stay in the upper half of the Bollinger Band complex. In a downtrending market, it will stay in the lower half of the Bollinger Band complex. And in a sideways market, it's all of the above, upper and lower. Here, same thing, right down there, all of the above, right here. And you can, of course, shrink or expand the time frame any way you want, but this is actually a really easy way for you, without even incurring too much brain damage, to know which way the trend is going. Like, hey, I'm a fair weather friend. Which do I want to favor, the bulls or the bears? When you see this kind of thing, it's a bear. You don't want to be a bull when there's a bearish trend going on. So this is just a really simple way for you to make sure you're on the right side of the trend. Okay. Diamonds, same kind of thing. Now with the S&P, 350 or 3,500. Is more, the short-term support here. I was sitting there watching TV yesterday with Jennifer, my wife, during the day when yesterday when the S&P was actually down. It was actually pre-market, and I was joking, and I said, well, shoot, honey, we've only got 500 more points to go down. And she said, she goes, oh, well, that's not bad, isn't it? Isn't it like at 30,000 or something like that? And I said, well, no, that's the Dow. I'm talking about the S&P, which is at, 3,500. And she's doing the math, and she goes, well, that's not good. And I said, no, it's not good. But I'm still sticking to my most stocks are crap call until we get somewhere down here. Now, most, but not all. And so we have to find the difference between the most and the all. And, we're looking for those, but you got to be really careful. And again, I'll talk in a while about the things that I'm going to be chatting with Ali about that are kind of right on point. So you don't want to fart around with this market right now. Sitting on the sidelines is not a bad place to be. I'm issuing some every so often. I'll give you some trading idea, but I'm just saying it right up front. I'm not pounding the table on anything saying, hey, buy this. Oh my God, it's awesome. I'm giving you trade ideas based on what's happening. Now, TBT, The short treasury, this has been a really good trade. It's up, I think, what, almost 15%? Maybe something like that, almost. But this has been a nice, smooth trade. By the way, what did I mention a little while ago about Bollinger Bands? Right in the upper half of the Bollinger Band complex. Now, how about Twinkie? Okay, it's a little sloppier. Certainly, recently, it's in both up and down. Generally speaking, back here, it was in an uptrend. But if if we just want to kind of draw these lines, we've got uptrends, but really kind of digging through the 20-day moving average, and then finally a peak, and then a pullback all the way to the bottom, and then also at the 50-day moving average, and then back up here. So, technically we're still getting higher lows and higher highs, but if you look at this relative to moving averages, relative to the Bollinger Band complex, it's actually kind of lower. It's lower than it has been. Like this tagged the 50. These did not. This didn't. This did here, but it was a quick rebound. So what I'm saying is this is not a trade. We're still profitable on it, though not by much. But it's a stock that's working, but I'm not looking to this as a trade that's really going to be awesome. I think it works, but you got to be patient. And my assessment as far as what a normal range for this would be right now, it's probably right around there. So it's got plenty of room to the downside before you could really say, I think this is acting wrong and I think the trend is over. Okay, now Lilly, I'll say it again, it's still working in that we're not stopped out, but it is violating one of my rules, which teaser, I'll chat about towards the end of this video. Okay, but it's still working. We're there. It's okay, but we're just not getting any bang for our buck. Entered at 333. Now it's at 332. So we're barely below where we entered. So it's really a wash. Now yesterday I covered a bunch of stocks, and so I'm just going to run through them again. AMR, coal. We like coal. The companies, not the material. Very dirty. So this is setting up really well. Now a jump up to 160 puts it within 15% of the 52-week high. And that's a technical development that a lot of traders look for. A lot of traders won't even really consider a stock that's not within 15% of its 52-week high for the simple reason that it's just kind of a check the box thing, where if it's not that close to it, then it's deemed to be too much supply overhead. And so you want to see it close, because that means when you think about it in a different way, if it's within 15% of its 52-week high, there aren't that many losers holding the stock. There are not that many folks that want to sell because they're upside down. Okay, so Haemonetics, nice breakout today, but then it pulled back. And so this is a classic case of what's happening right now. By the way, where's the stock trading within the Bollinger Bands? I don't need to tell you. Well, we'll do it this way. Here's where the stock's trading within the Bollinger Bands. All up and down, everything. And then so you stay away from this. You watch it for a change in character. And then we could look at the same thing here. Where's this stock trading? Trying to get up, but this is way too tight. Okay? These bands are way too loose. These bands are way too loose for the stock to be giving you much upside from here. So what we'd really like to see is more sideways action for a while, and then the 200-day start to drift higher, and then that gives us a springboard from which the stock can move higher. But for now, this is just one to watch and nothing more. Now, spoiler alert, really not going to be telling you any stocks that you got to buy right now. A lot of them are just like this. Unum, it might have been tempting to buy this stock yesterday, but I'm pretty sure I mentioned that it's just too extended, it's just too high, and if you look at it this way, the stock is in a nice drifting move higher, but it's just not one that I would look at and say, wow, I got to buy this stock. But it's one to watch. It is still kind of right in the middle here. Nice slope of the 50 and the 200, but frankly, I would rather the slope be a little more gradual because that would mean the stock would still just be drifting sideways. See, I'm talking about this stuff just because I think that it's something that that a lot of people don't really think about, but it's important for you to know that I never even think about that, and maybe some of you don't either. I never think about it because all I would do is just look at look at a chart like this and say, oh, I like it, but it doesn't have that look to where I want to buy it. And then if you said, well, what do you mean by that look? Then I would start describing the various components of a chart, and one of them would be the slope of the 50 and the 200-day moving average relative to the price, et cetera, et cetera. So reason I'm saying this is that if you just look at enough charts with a critical eye, sooner or later, a lot of things that you're thinking about now, you're not going to be thinking about later. It'll just be automatic. Okay. Neurocrine, same thing, really looks like, still does, but it looked like, oh, this is a really nice setup, but you can't look at this and buy it because there's really no difference between this and back here or any of these other places. You know, there's really no difference. So the stock pulls back today it's very predictable here. And I'll make another prediction. I'll predict that on Monday, stock's going to trade somewhere in this range. I'll predict that the stock will not, on Monday, move up to here. If it does, then I'll say, well, that's a trade that I missed. So, but we watch it. Now, I posted about this, Kiko, I guess that's how you pronounce it, this morning, that it was breaking out, but it was super thin. And guess what? The breakout didn't hold. Okay, it was up really nice. I took some at 10 bucks, so slightly over 10. I had looked at this yesterday. I suggested setting an alert at 9.90. So I saw it. I'm going like, I'll take this for a ride. And then I wound up selling it, and I didn't sell it at the top. I had other stuff to do, but I did sell it for a very slight profit. And point being here that when you're trading in this kind of market and you're trading a breakout, you really don't want to overstay your welcome. And it's quite easy to overstay your welcome. Generally speaking, breakouts are not holding. So they can be opportunities to capitalize, but if you're capitalizing on them, you want to be using your stopwatch, not the calendar. Now, Aveo Pharmaceuticals, this is the one breakout that actually has worked today. You know, I mentioned that yesterday, and this is kind of coming out of, you know, a multi-year base, so to speak. The 50-day moving average, the slope of that, guys, you see it's not as steep as the other one was. This has already made a pretty nice move, but I'll just draw it in a different way here. Bounce off the 50, you could say that's kind of phase one. A pullback to the 50, that's phase two, and then finally a phase three, we're getting a follow through here. So this stock looks like it could go higher, but frankly it's up 5 1/4 today over the last, since what was this, Tuesday? Let me pull this out of the way. Since the Tuesday low, this is up 26%. Something tells me that this isn't something I want to buy right now. But you want to watch it. It's up there for a reason. huge volume on this stock, and so nobody's buying this stock just to dump it on Monday. This has some legs, and it's probably going higher, but now you just want to be careful about where you buy, when you buy, or frankly, even if you buy. Okay, Iridium, mentioned that all of these are things that I mentioned yesterday. It's really wide. This is really wide. Right here, breakout, pull back to support at the 50, and now we're looking for higher prices, which we got today, higher intraday high, higher intraday low. But guess where this is? It is still in the box. So you watch this. Note how wide these Bollinger Bands on. They're 15% away from each other. That's too high to really qualify as a squeeze. Okay, Ionis still pinching here. Nothing to do here. I'm going to go ahead and suggest setting an alert at 47.75 and also 44.70. And the reason for that is I want to see if this starts breaking out to a new high. I just want to know about it. I'm not just going to go, oh, I'm buying it, but I want to know about it. But I also want to look and see if I can catch it on a pullback, because the last several times when it's been at the 50-day moving average, that's when the stock has been buyable. And so that's what I'm looking for here. Now, Texas Roadhouse, I'm pretty sure I mentioned this yesterday, that this is looking real strong, but you can't buy it because it's already gone up too much. You look at this stock here and you can't say, oh my gosh, it's Thursday and this is really going 3 big days in a row. I'm going to buy it and ride it on to victory. I think ultimately it's going higher, and as I mentioned yesterday, I could see this stock hitting 110, but not tomorrow. But this is what I'm looking at. This is a pretty nice constructive pattern here. Nice little pullback on fairly light volume here, and now we're starting to get some good pin action, but you got to wait. You got to wait for this to set up a little better. Dino, still setting up here. Nothing to do here. 50-day moving average is where the entries have been. This is not that. We've got $60 here at some pretty solid resistance, and so you want to watch this. I'll just put it this way: if you're framing a risk reward on this, your potential reward is $3.74 from 56.26 up to 60. That's where you gotta assume we're going to see. Where you got to assume you're going to see some selling. So it's not yet at this area where you want to be buying. Okay, now Consol Energy, another coal stock like AMR, still setting up. You got to watch it, but don't buy it. It's a good sector. That doesn't mean this is going higher. In fact, if you look at, I look at some of the sectors, some of the really, really strong sectors on MarketSmith. And I'll show you something. Hang on, let me set it up. Okay, I'm looking at this on MarketSmith. These are all the industry groups. There's 197 of them, and I've got them ranked in order of strength, first through 197. Now, the first one here is oil and gas, but I want to look at this one. You look at the next one is energy solar. So these are all the solar stocks, and there's a boatload of them here. Okay, this is number 2. Okay, last week it was number 2. 3 months ago it was number 3. 6 months ago it was 111. So you're looking at this and saying, wow, there was a big jump between 3 and 6 months ago, and since then this puppy's been really, really strong. But if you look at the way the stock has been trading, it's really pulling back. And so, well, why is this number 2 if we have this pullback? Well, relative strength rating. Even though this is pulling back like this, it's still outperforming 99% of other of other stocks, of other sectors, really. And so that's a big, massive bit of information that even though this is trending down, it's still outperforming virtually everyone, which indicates that this is a really weak market. And so then if we look at the S&P, we know why. Because it's like this sucks more is really the way to say it. And so what I'm saying is, just because you have a stock in a strong sector doesn't mean that the stock's going to be strong. If we want to just look at a couple, First Solar is kind of the best of the bunch. But if you look at Enphase, not so much. CSIQ, definitely not so much. SunPower, not so much. I could go through all of them, but I'm not going to. So these are all bad. So they're in the number 2 group, but the stocks themselves are doing horribly. So for you just to be basing your decision to own or buy on the strength of a group, you're missing something. And you put it this way. Joe Namath, yeah, but Joe Montana was a hell of a quarterback. He was the best in the NFL. But I wouldn't want him on my team now because I'd say he's kind of peaked quite a while ago. And so nothing against Joe. Love him. But the point is, same thing with solar. These stocks have peaked a long time ago. And so if you're going to draft these stocks for your team, you're kind of getting the has-beens. You're getting the ones that used to be great, but not so much anymore. And you don't want that. You don't want that at all. And so you got to make sure that you're in the right stock at the right time. And so Consol Energy, I'm looking at this, and there's a lot of good things about it. But if I look at the accumulation distribution of the stock, it's even. The weight is just on the same par as the lift. Demand, supply, about even. And that's just a simple reading on MarketSmith. There's no detailed analysis for me. So that's fine. It's even. Oh, that's a good thing. Well, what do you think it was here? Okay, here there was much more accumulation. The stock was much lighter. Lots of accumulation, not so much distribution. So that has now changed. And this is what happens. This is typical Wyckoff analysis. There's 4 trends. There's the there's the mark up. Stocks are going up. We like that. There's the distribution. Then there's the mark down, and then there's accumulation. So right now, you got to say this is still in the markup phase, but maybe it might start being in the in the distribution phase. And you don't make money in the distribution phase. You make money in the markup phase. So anyway, with that said, I want to I'll just kind of show you my notes here, just so you've got something to read while I yak about this. So these are just some things I wrote off the top of my head. There's no particular format. It's just kind of stream of consciousness stuff. But in trading, as a trader, as a pro trader, always, your first priority is not to lose money. That's it. Nothing else matters if you're losing money. Money is your stock and trade. If you're a gunslinger, the first rule is don't run out of bullets. Don't waste your bullets, whatever the case may be. If you're a chef, don't run out of food. The list goes on and on. It's the first rule of basically life. Don't lose what you need in order to get what you want. So you don't lose money. Even the small losses add up, and if you're trading a lot these days, you're taking small losses. Trading with discipline requires 2 elements, and that is to sell before you take a big loss, but also make sure you're only taking entries at the right time, and you're being very strict, and you're only taking small, what they call pilot positions, just little dip a toe in the water positions. And the math doesn't work if you're doing it different. One big loss is the worst. You put all of your account in one stock and you lose 25%. Well, then you're really screwed because you got to make 33% to get back to where you were. And if you're bad enough of a trader to lose 25% on one stock, what makes you think you're going to be a good enough trader to make 33% on the next? The math just doesn't work. You drop 20%, you need 25. And so think about this. If you've been trading a lot recently, really in 2022, if you've been trading a lot recently, then you're probably taking these little nicks and cuts. You're getting, as they say, death by 1,000 paper cuts. And so, I'm only, I only take an average of 5%. I'm only losing 5% on average per trade. So that's not bad. Well, yeah, but if you're making 20 trades and each one you're losing 5% on, well, that's 20%. That's 5% of your entire account. Even though you're taking really, really small initial positions. So you have to be looking at this like, how am I doing? If I'm having a string of losers, then you're simply doing something wrong. I don't know what it is. Maybe you're just trading. Maybe the market's just totally not friendly. Or maybe you have the wrong tactic. Maybe and this is something that, I've discussed many times, and that is, are you trading breakouts? Because breakouts aren't working. We can still look at them, and I mentioned there was that one CECE that I took at, it was actually $9.98 when I bought it, and I flipped it a short time later. I let everybody know that the stock was breaking out, but also mentioned I'm not putting this on the list because it's too thin, and breakouts aren't working, but make your own decisions. The point is, that breakout worked fine for me, but typically they don't. So if you are still trading breakouts, you're kind of doing something wrong, and that's the whole point. And you'll be getting this big string of losers, and you can always just step aside and regroup. The other thing is, second priority, as I guess I would say, is make money. Your first one again is you don't want to lose money. So if you're not losing money, now you want to make money. And cash, by the way, they say, cash, you're not going to make any money. And you'll hear money managers say that all the time. If you've got somebody running your money and you say, hey, you know what? I need to increase my cash allocation. I don't like the market. I just need to go more to cash. That money manager will virtually, unless it's like your cousin or something, that money manager will virtually always say, well, why don't we do this? This is safer. We'll put you in a high yielding blah bitty blah, whatever it is. That's safer. That's way better than cash because at least you're getting something for your money. And that's all well and good. Because, hey, we do have 8% inflation. So if you're just in cash, you're losing 8% per year of just buying power. But if the market's going down and you're losing 10%, then are you really losing 8% on inflation? No, you're actually making 2% because of the 10% decline in your cost basis, and you've only got 8% inflation, you're 2% to the good, okay? And by the way, so if you take that 10% loss, you're holding this, and oh crap, it's down 10%. Well, that's not bad. Okay, but there's 8% inflation, so your money isn't sitting static waiting, just dealing with this 8%. You're down 18%. So again, the math doesn't work. And also with money managers, and I know we have several that are members here, and so I'm certainly not disparaging you at all. I'm just talking about what your business is. You don't want your people to go to cash because there is a chance that they'll miss something, and then you're falling back on that. Well, you're just you're trying to time the market, and nobody can time the market. And I agree with that. Certainly with big money, I don't really think you can. I think you need to be you need to be looking at the gray. there needs to be kind of a sliding scale of risk. How much risk am I taking now relative to the reward that I think I can make? And so it should always kind of be somewhere in the middle. And sometimes it's all the way cash. Sometimes it is. The problem, or I should say the challenge, is a lot of times when you decide you're going to go all the way to cash, it's only because you've taken so much pain that you just can't stand it anymore. And now you go to cash, and sure enough, the market whipsaws, and you wound up selling low. And now you're going to be buying back higher. So that can always be a problem with you, and good money managers will caution you against that and say, well, Christ, let's put your money, sorry about that, let's put your money somewhere. So because then they're earning their fee. They are helping you out, and these are all good things. Again, I'm not disparaging anybody. I'm instead talking about the merits of having somebody good. They're always trying to find some place for your money to work. However, when it gets right down to the bottom line, it's your bottom line. And so you want to be ready. You want to be able to say, no, you know what? I'm just in cash. I sleep better, and I will risk missing out on 8% for my peace of mind. So it's just something to think about. But the other thing is, and this literally takes me to Lily, don't be stagnant. The longer you're in a position that's not working, the more your risk increases. Well, why is that? Because you were wrong to buy it when you did. So what happened? If we look at Lily here, bought it on this breakout. Okay, my bad. Somebody even asked me in the forum, like, hey man, I thought you said like breakouts weren't working. Why are you doing this? And I'll say, well, I made a mistake. However, is a little bit more clarification. I feel like if I see a breakout that looks like it could work, I'm going to mention it. But I also say, hey, you got to make your own decision. So, but if I knew that the stock was going to be doing this since I bought it, would I have done it? And I would say no. I was wrong to buy it here, even though the trade is almost flat. I'm just down just a very, very little bit. But I was wrong about the trade. I'm down like 1/3%. And so the longer you sit in a trade that you were wrong on, the wronger you get. You got to have your money moving. You got to have your money working. And if it's not working, then it needs to be someplace else, even if it's just on the sideline. Okay. So just a few more things here. Your methodology, there are two parts to every trade. There's the decision and the action. You make a decision based on your plan, and then you take action based on your decision. It's not one right after another. You plan. What's your time frame? What are you thinking? You got a long time frame? What's a weekly chart looking like? What's the market looking like? How is the group strong, or is this kind of a one-off? Okay, what's the daily chart looking like? What's your methodology? Where do you buy? What do you typically do? What looks good? What doesn't? What entries have been working versus not working? Again, like breakouts versus pullbacks. All of these things. It's like, yes, I want to buy this stock, but how am I going to do that? I'm making a decision, I'm going to buy this stock. And then your decision finally is, yeah, I'm going to buy this stock. Now you switch to the action part of it. Okay, you're going to buy this stock right now? No, you're going to buy this stock when it does what you know that it needs to do. All these stocks that I mentioned, most of them anyway, I say, hey, you can't do anything now, but you got to watch them. So in effect, we've kind of made a decision, at least enough to watch the stock, but we've made the decision, hey, we want to buy this stock, so let's go. No, we've made the decision. We want to buy this stock. We will take action when, and then go back to what I've said. So there has to be a space between the decision and the action. Otherwise, you're going to just be impulsive trading. That's what it is. Okay, so then as a part of this thing, with respect to time frame, you have to have a plan, and I've talked about this a lot. Your plan requires a time frame because the time frame drives your research and your analysis. If you're looking at fundamentals, group strength, the longer term stuff, that matters, but not if you're doing a swing trade for 3 days. All you care about is the price action. Similarly, if you're doing day trading, you really don't care what the book to bill ratio is. So you're making a decision, you're taking action, and then you're looking for traction. If you're not getting these 3 things, then you're in a trade that's not really going to work. So then I'll stop here with Tesla, long or short. So the majority of option trades today were on the call side, not by a lot. I think it was 55% this morning. I saw this on John and Pete's site. 55% were calls. Calls are speculative. Puts are hedges. Okay, puts are protective. So 55% of option traders were putting their money on speculative stuff, which is what you do when you think the stock is going higher. So if we look at the daily chart, it was oversold. So we're getting a rebound, right? But if you're looking at the weekly chart, this actually peaked last November and is now in a downtrend. You'll look at the 20 and the 50-day moving averages. Okay, so everybody was all lathered up. Everybody's all lathered up to buy this stock because it was gapping. I mentioned it yesterday, and not in a real bullish way, but in a real cautious way. So the stock gaps up. Everybody's in on Tesla. And then the stock virtually immediately trades down below the VWAP and kept going. So all those calls that people bought are down a lot. Some of them, if they bought the weekly calls that expired today, well, they're worthless. And so this is a bearish engulfing pattern. So what are we looking at this? Well, we're saying that, all right, on a short-term basis, on a daily chart, you would look at this and say, okay, this is set up for an oversold bounce. And then let's see if I can get it just to 1 day. I may not be able to. You're looking at, forget about this. I'm sorry, I don't have that kind of granularity here, I guess. But yesterday was a big day, heavier than average volume, so maybe we get a big third day. That petered out, before your second cup of coffee. And then now the stock's moving lower. Well, is that really a surprise? No. You look at the weekly chart, this puppy peaked last year, and it's just been drifting lower ever since. So the point is, are you trading Tesla? Fine. What are you doing? What's your time frame? What's your plan? Is it just because somebody in the forum said, oh, I got a short, I'm shorting Tesla, or somebody said, oh, I'm buying Tesla? No, you have to make your own decisions. When you make your own decisions, you're going to come up with better decisions because they're yours, and you're going to know when you're wrong, as opposed to having to wait for somebody who posted something in the forum or on a newsletter or something to tell you, hey, by the way, I was wrong. Okay, so these are some of the things that you really need to be focusing on in your trading, and this is a great time to be losing money if you're not doing these things. But it's an awesome time to be learning and thinking and creating lists and watching things like I do, where I'll feature a stock and then we'll cover it over the next several days. So we've got this kind of this lab, this trading lab that goes from 1 day and 1 week to another, where we're learning all these things, but you're not losing your butt. And hopefully you're making some money. All right, that's it. See you all on Monday.